So we are up to our segment of Your Questions Answered. And at this point, we would like to bring back Chip Allen, who is our AVP in Inside Mortgage Sales. And alongside him, we are going to bring in another expert, Chris Givanakis. He is partner at Givanakis and Corona PLLC. He has 18 years of real estate experience, over a decade of representing purchasers, sellers, lenders, developers in the real estate and banking. And through his work with the United Nations Federal Credit Union, he is uniquely positioned to help foreign and first-time home buyers unfamiliar with the New York procedure. So I'd like to welcome you both back to our Q&A section. Well, back for Chip, but welcome, Chris, to our Q&A section here.
Thank you.
Thank you. And, we want to kick it off right to you, Chris, so you can share your expertise with us. So first question up is, how do closings happen now during a time of this COVID and pandemic that we've seen? For instance, like remote closings, hybrid closings. What have you seen? Can you kind of give us a picture of what that looks like?
Yes, and I want to talk about it kind of as a sliding scale, because I feel that since COVID happened in March 2020, wow, we're going on 2 years now. We're over 2 years. But since COVID happened, I've noticed that it slides back and forth, really depending on how many cases there are at any given time and where we are as a country and as a state and how we feel about it. So going back to day one was probably the most severe that everything changed. And it was before even the idea of a hybrid closing came up. So I would say that I was just signed a lease on a brand new commercial space for my office, building out conference rooms so people would come in, and big open floor plans for people to come work. And the very next day was when the shutdown orders came through. Now, I obviously work for more than one bank. I obviously work for more than one buyer and seller at the same time. So if I go through all of my banks and tell you what they did, there's going to be tweaks here and there. But what generally happened on day one was we got calls from our banks saying there's a definition of what is an essential worker. Mortgages absolutely are essential. And the reason being is people need money. A lot of people needed to create that nest egg. So I'm not going to name names, but some of my banks sent messages that just said, we are going to do business as usual. You are expected to go to every closing. We don't want to hear from the borrowers that anything is being done different, because if there is a complaint, it will be against you, which is a very scary thing to hear, because I have people that I send into people's homes and we set up closings that could be up to 10 people, and we didn't know what was going on. And I didn't think I'd get to a plug for the bank so early, but the top brass, Chip included, operations managers got on the phone with me within 24 hours. It would be probably overstating it, to talk about what the new process was going to be. And it wasn't, how are we going to get these loans closed? The important thing that was asked of me is, how are we going to get these loans closed safely? We had a minor pause, and even for most of those, I don't think we slowed down on loans. So I would say the first thing that they figured out we could do, there were emergency orders put in that allowed online notaries. Now, online notaries could mean a million different things, but the New York way of doing business for an online notary meant that somebody had to physically sign pieces of paper, but the notary, whose job essentially is to watch somebody sign, confirm who they are, and verify in writing that this person signed. It sounds simple, and I'm sure everybody's gone to the bank and done a notary before, but it is all important to the mortgage process, because documents that get recorded with the state that finalize mortgages, documents that get brought to the bank that are necessary for finalizing a mortgage, have to be notarized. Not every page, but there's at least 20. It's not the type of thing that we can skip past. So I think I went from a bank attorney to what I call the logistics manager within that first week, because what we found we had to do was get packages into borrowers' hands. They had to physically hold it. If they couldn't print it, we had to mail it, messenger it, or we had to hire a team of people that would deliver them on our own. So we were sending out anywhere from 8 to 20 packages a day for closings to be dropped off in people's mailboxes. And this is going back to when I say there's a sliding scale. Back then, I think people left them in their mailboxes for 2 days. then sprayed them with some spraying alcohol, then brought them inside, wore some gloves to open them. Which is just what we thought was safest at the time. So we couldn't just get packages out the day of the closing. I was able to coordinate with the United Nations and say, I need to get these documents in their hands 2 days before. And I know we're all very busy and everybody was learning how to work from home at the same time. And it just happened. The bank held up their end of the bargain and we held up ours. From there, we were able to jump on Zoom, following the New York State requirements. We actually had to record everything and we have to keep a database of every closing. We were able to jump on Zoom and do the closing there, have them leave the packages for us to pick up and then send them out. This is the most severe remote notary. This is the most severe online closing that you can have. Nobody meets anybody else. Packages were being delivered through Windows at most. There's another way that we were able to do business that was slightly softer. Other banks would not allow us to do the online notaries. So what other banks would have us do is sometimes try and meet somebody outside, although early on people weren't willing to do that, or sometimes watch them sign through a window and then have them pass the documents back afterwards, which was nice if you have somebody with a front porch or a back porch where you can look through windows and you can close that way. That method worked very well for refinances because in a refinance transaction, when somebody already has a home and they want to get a new loan, there's only us and them, the borrower and the bank attorney. However, we also work on purchases and sales. And now I'll sit in many seats in purchases and sales. So I can sometimes be representing the bank on a purchase. I can sometimes be the seller, or I could sometimes be the buyer. I think for the purposes of this symposium, it's best to say from the buyer situation, what I needed to happen. So the first thing that absolutely had to happen was I had to get any document from the bank and get those signed, but we're already good at that. Next, we need to get documents from the building that you're buying from. Now, you could be buying a co-op, you could be buying a condo, or you could be buying a single family residence. Let's keep it to co-ops and condos because if we're staying in New York, that's going to be the majority of our purchases and sales here. When there's a co-op and a condo, there's another part to the transaction. It's not just the seller. The co-op and condo have their own documents that they need signed. They might just be simple pieces of paperwork that talk about when you move in, is there a smoke alarm in the building? Is there lead paint anywhere in the building? Or they might be more severe. In a co-op, there is actually something called a stock and lease. And I'll talk a little bit more in a later question about the layout of a co-op and what the reason for the stock and lease is. But a stock and lease is an irreplaceable piece of paper. It is, the original has to be in my hands before we close. That means a building, and I love buildings, I love co-ops, I make money by helping people buy them. They are notoriously not the fastest people in the world. Getting something like a stock and lease from the manager of a co-op could take weeks. So that was something we had to plan out in advance. Once we had the stock and lease in our hands, we could start negotiating with the seller about the closing date. Sellers actually have it easiest in this transaction because the seller has about 5 pieces of paper that they had to sign and they would send it to us. So I would start gathering, as the buyer's attorney, all the documents that we would need for closing. Now, this sounds unique and novel to me because I was from New York, but believe it or not, if you're out in California, this has been happening for years. This is kind of how closings would go. This is known as an escrow closing. However, New York is not an escrow state. So we were trying to kind of fit a square peg in a round hole and learn it as we go. Once all the documents are together, we have to get the money to every party involved. And I think that is probably the scariest part of a remote transaction. We are no longer cutting checks and handing them over to the person on the other side of the table. That's very common in a New York style closing. You bring a certified check, the seller takes it in their hand and walks away, and they're confident in the check that they have the money from the sale. But I can't so much on a remote closing convince a seller that I'll mail you the check afterwards and you'll have it in about a day or two, but let me record the deed. Let me be the owner and I promise I'll send you the money. It creates a stalemate and they might not be comfortable doing that. So what we've had to do in order to make up for that is send wires. And sending wires is a blessing. It is very quick. It is the best way to get money in someone's hand. It is instantaneous. It's probably faster than a certified check because I don't have to go to the bank to cash it and wait for it to clear a day or two. And the other side of wires is there's a finality to it. So if I send a wire, if my client sends a wire, once it leaves their account, it better be going the right way. And I think we've all probably started hearing stories over the past 2 years that wire fraud is at an all-time high. It is the scariest thing in this business for me, meaning that I have to learn how to double check and triple check every wire that goes out. Now, when I'm sitting in the well, let's start with the bank. When I'm sitting in the bank attorney chair, I am sending out money on behalf of the bank, and I have a duty to make sure that I'm sending that money the right way. So I will make every phone call that I need to make sure it goes out. As the buyer's attorney, and this is something we kind of learned as we went along, I am not always the one sending the wire. And that's not a great thing, because if the buyer, and we have many first-time buyers here, if the buyer has to send money to a seller at the end of a transaction, whatever the difference between the purchase price and the mortgage is, they can't go to the bank and certify the check anymore. They would have to send a wire. A wire from a private citizen, a wire from a regular bank account can take days. And we don't always have days. So what I learned that we had to do for my buyers is figure out the closing costs 4 or 5 days in advance, have them wired into my account, confirm receipt. And then on the day of closing, when everything's complete, I can use my corporate account to wire everything in a matter of an hour. And I think that's the most important thing I'll say to in the modern way of doing closings, is that we're going to have to make sure when you pick your attorney, you should ask them their wiring capabilities, because sellers don't want checks anymore, and buyers aren't always able to send checks immediately. Now, other than that, most of the changes that we've had since then were hybrids of the two. So it wasn't always doing the closing online. Once we felt more comfortable and we understood COVID a little more, we could have 2 people meet in a room instead of everybody meet in a room. So we would meet in pods and deliver documents over afterwards. Or in the case of my office, we would sometimes do closing in separate rooms because we were able to do it, which ended up being a benefit of having the new office that we wouldn't have had before, that we could do the closing semi-live and have everything done on the same day. But we didn't have to have 14 people in a room, which I think even last summer, nobody was comfortable with at all. And that was probably the safest point before this last 30 to 60 days. And I think that's about how much it's changed. And right now, I'll say that closings 90% of the time are like normal. People are sitting down, but there's still people who insist on doing it the remote or a hybrid way. And they're absolutely entitled to ask for it. And we have to be ready to do both.
Excellent, thank you. It's good to know that we're probably slowly but surely getting down that sustainable path with closings. I know Lisa talked about a lot of risk work there, signing documents, but if we've eliminated the paper check, that's definitely a step in the right direction. Tip, is there anything you wanted to add to that from UNFCU's side as far as closings?
Not really. I mean, there has been a lot of coordination between our, steady handful of bank attorneys. Listen, we're a credit union, but we're still called a bank attorney, such as Chris. A lot of coordination with our operations team on making sure that everything is done safely, legally, securely. And listen, we've changed over time too. So some of it is obviously still evolving, and will continue to evolve with the changes that take place by New York State, by whichever state that we're doing business in.
Excellent, excellent. There is some inquiries that we had earlier and here as well when it comes to G4 visa. So kind of moving to another topic now, but are there eligibility restrictions on mortgage loan programs, Chip, for G4 visa?
Okay, so for G4 visa holders, are there restrictions on their eligibility for a mortgage? And surprise, surprise, I've got a short answer and I've got a long answer. The short answer is that no, there is not any type of restriction on eligibility for G4 visa holders. But that's the primary part of our business. So a major goal for the credit union is to develop and offer programs that are available, of course, for U.S. citizens and permanent residents, but also for our core members, which are UN staff members who are typically holders of a G4 visa. Now, Yes, the credit union does offer, I mentioned, such as a Veterans Administration loan. These are US-based loans that are only eligible for or available for US citizens or permanent residents. Those types of programs make up less than 0.5% of our mortgage origination business. So those very slim offerings aside, I would say that no, there's no restrictions. Of course, there's going to be a caveat to that, and the slightly longer answer is going to be some of the low down payment options that I mentioned during my presentation. Those types of loans require an added type of insurance. Very briefly, for any lender in the country, basically, if a buyer or if a borrower, a member in our case, is making less than a 20% down payment when they're purchasing a property, an added type of insurance would be necessary. And it's called private mortgage insurance, or people call it PMI. So this is this added insurance that a borrower or a member pays to insure us as a lender in the case of a default. Nobody wants to pay insurance. I mean, I don't like to pay my car insurance either, but it's a sort of necessary evil in certain mortgage situations, such as the lower down payment loan. Private mortgage insurance, or PMI, is offered by these independent third-party US-based financial institutions and insurance companies. And to them, it does not matter if someone has a G4 visa or not. To them, it matters if someone has a US credit profile. So the restriction for a G4 visa holder may be not the fact that they hold the G4, but the fact that they may be new to the US and do not have a credit profile that is robust enough to qualify for this added insurance. We do have some workarounds to work with a member on that, but ultimately that member may not be eligible for some of the programs that we offer, such as the 3 or 5% down payment loans. We have a very close relationship with one of our PMI companies in particular. We work with them to make alternative documentation mortgages available. I would just say also that this same restriction would apply to a US citizen who, let's say, has been working abroad for 25 years and also has no US credit profile. So these restrictions are credit profile based, not immigration status based, although those tend to go hand in hand. So short answer and a long answer. That's a little bit of both.
Okay, excellent. So I kind of want to piggyback on that one. If there's anything different than from like a seller versus buyer when it comes to G4 visa holders.
Yes, and this one might be a question for both Chris and me, but you know, when a G4 visa holder is selling their property, well, let me back up and say this. When a US citizen or permanent resident is selling a property, a primary residence, so we're only talking about primary residences here. Second homes or investment properties are in a different category, but for the sale of a primary residence, I, as a US citizen, am eligible for a certain amount of exemption from federal taxes called capital gains tax. For an individual, that exemption is $250,000. For a married couple, it's $500,000. So let's say you've got a married couple, they're G4 visa holders, and they're selling their home, and they've realized, fortunately for them, good investment, they've realized a $400,000 increase in value. And so they would be, the G4 visa holder is eligible for the exact same exemptions from these taxes that I am as a US citizen. The difference is when I sell the property as a US citizen, the exemption kicks in immediately. It kicks in at the selling or at the time of the closing when the sale is taking place. For the G4 visa holder, that money is going to be held. Another reason why it is super important to have a veteran, experienced real estate attorney representing you, because your attorney is going to be involved in this process. Basically, the G4 visa holder has to go through a series of paperwork to have the exemption that they're eligible for applied to the gains that they made on the sale of their property. So ultimately, they're going to get that money back, but the money that would typically be held for a capital gains tax is going to be withheld for a certain amount of time until it's effectively released by the IRS, and then they get that money. Basically, there's a timing issue. So yeah, there are differences for a G4 visa holder when selling a property, and Chris ultimately would have more experience with those issues maybe than me. If there's anything that you want to add on that, Chris, on what is relevant for someone selling.
I think it's a perfect explanation just from a mechanical standpoint, because my job is there to do the numbers at the time of closing. The withholding amounts are set by statute, and it's pretty easy to figure them out. If you're selling your home under $300,000, there is no amount of money that you have to withhold. You're actually fully exempt at that case. From $300,000 up to $1 million, if you're using the property as your primary resident, you're going to have to set aside of the total sales price 10% of the wholesale. So if you're selling for $999,000, you're going to have to set aside $99,900, and you're actually going to have to send it to the IRS. From a timing perspective, you're going to ask for your money back, but you don't get it all. You're just going to pay a tax on the profit. So what you're going to do is wait until the next time taxes are due. So this is frustrating for some buyers, but what you might end up having to do is set aside this 10% and apply for it back the following April. So if you're closing in January, it could be a full year before you get that money back. The only other time that number changes, if you're over $1 million or you're not using the property as your primary residence, you have to withhold 15% of the sales price. So these are large numbers. In a worst case scenario, and I'll tell you, I've done it once or twice in my entire career. If somebody cannot afford to set that money aside early on, you can request to have that money pulled out before closing, but it can take upwards of 5 or 6 months. And that entire time, you have to be in contract. So if you need to do it, we can find a way to do it. If you have a buyer that's patient, we can. But for the most part, you should be planning to set aside that money for a period of time.
All right, excellent.
You learn something new every day. Thank you.
Yes, we do. Thank you. So let's see if we can learn a little bit about this first-time home buyers program. So we have a member that had asked, what's the criteria to be eligible for this first-time home buyers program?
Well, the first-time home buyers program that we offer internally, so our own UNFCU program, really does not have much in the way of restrictions. To qualify as a first-time home buyer, it means that you have not owned a piece of property, a piece of real estate for the past 3 years. So you could have owned something 10 years ago, sold it, and you are, in the eyes of this program, you are again a first-time home buyer. The first-time home buyer, as I mentioned, or the first-time home buyer program, as I mentioned just a few minutes ago, does require that you qualify for this private mortgage insurance. So it does mean that you would have to have a credit profile. You have to have an acceptable credit score or credit profile to qualify for the first-time home buyers program, which means for someone who's moving, to the U.S., to qualify for that type of program, they would probably need to plan on perhaps renting for a year, establishing their credit in the U.S., paying all the bills on time, and developing a good credit profile, which again, our mortgage representative team is more than happy to assist with. And then applying for that type of mortgage, because to buy a property with no credit profile established requires a 20% down payment. So main restrictions for first-time home buyer: you haven't owned a property in 3 years, and you have an acceptable credit score and credit profile in the United States.
Excellent. And the benefits to that program, what would those look like?
Well, the main benefit is the very limited amount of down payment. I mean, traditionally, just in the United States, 20% is the expected down payment. I mean, just for decades and decades, that's how much money someone was expected to make as a down payment or to put toward the purchase as their down payment. Private mortgage insurance was developed to allow people, members, buyers to purchase a home with less than 20% down payment. So the benefit ultimately of the first-time home buyer program is the ability to buy a home with as little as 3% down payment. You have to qualify for it in certain ways or other ways, but that's the benefit. It's the limited down payment. Not having to save for X number of years to build up a 20% down payment. You know, maybe you're saving for only a year or two so that you can make a 3% down payment.
All right, excellent. Thank you. So you had mentioned about folks overseas and then coming to the U.S. So the question is, if these folks have property that's owned outside of the U.S., is that relevant to the home purchase here in the U.S.?
Of course, I'll hit it first. I mean, we can see, you know, how much what ties in for both of us, but again, it's sort of a short answer and a long answer. I mean, really, no, the property is not relevant to the purchase in the United States in and of itself. So you've got someone who owns a home in Morocco and they want to buy a property in New Jersey. And so they speak to their mortgage rep and they say, hey, I own this property in Morocco. Can I pledge that property, or can I use the collateral or equity that I have in the property in Morocco toward the purchase of the home in New Jersey? And the answer to that is no. There's just not a legal mechanism in place that would allow us or any other U.S. lender to file a lien against a property in Morocco, which is really what would have to happen in order for us to use it as collateral for our mortgage. It's why we don't, except under a very limited basis, you know, in Uganda and in Kenya, we don't offer mortgage programs outside of the United States because of this issue of legally being able to file a lien against a property. Okay, so you can't pledge your property in another country toward a loan here. However, let's say that same member with the property in Morocco earns rental income, and they need that income that they earn from their rental property in Morocco to qualify for a particular home that they want to purchase in the United States. Then that property becomes relevant because if we can document the income that's earned, leases, tax returns, depending on the country where it's owned, proof of income, also any proof of carrying costs, meaning if you have taxes or insurance to pay. But once we've ironed all that out and netted it out, if we can document the income from this non-US property, then sure, it is relevant because we can add that income to our members' UN salary.
Thank you. Let's see here. I'm going back to the chat to see what's coming in, and we had talked about qualifying. So here's one. How can you qualify if you do not live permanently here in the U.S. and your post is working overseas?
Well, it's fine. Great question. So someone has a duty station in Dakar, and they want to buy a home in Massachusetts. Especially if this member works for the United Nations, I mean, the income works the same wherever the person is posted for their duty station. Depending on the duty station, there may be some aspects of this person's monthly or annual income that we can't use, like hardship allowances and so forth. But in general, the member would lives in this case, Dakar, and wants to buy a home in Massachusetts. We would qualify this person based on their UN income and whatever other sources of income they may have, as long as their income is sufficient to support whatever housing expenses they have in this case, Dakar. It's sort of expensive, but and the new housing expenses for the property that they wish to purchase in the United States, then fine. We do it all the time. So we have members not living in the United States, but want to purchase in the United States. To be honest with you, if this member works for the UN, it's really quite straightforward. They simply have the added expense of their housing costs wherever they happen to live, where their duty station is. That expense is built into their qualifying ratios. As long as they qualify, then we're ready to go. We do it all the time.
All right, that's good to hear. Good to hear they have opportunity there. We're actually going to move back to the G4 visa. So how does a G4 seller, oops, it's moving on me, here we go. How does a G4 seller get back the capital gain tax if they're leaving the US 2 months after their house is sold?
Very common, actually. Yeah, I can take that one. That's very common. I mean, very often UN members, especially, are selling their home because they're getting ready to move to a new location. There's two sides to it. The simple answer is when you give the money to the government to withhold, you have to fill out a form stating a foreign address where you will be, and that can be the place where they send the money. But even simpler than that, 99% of the time, especially with my buyers, I will put you in touch with an accountant, traditionally an international accountant that understands UN members a little better, who is able to file for you and get it back into you, whether it have to go back from wire or a check to where it needed to go.
All right, excellent. So we're continuing to build this team Chip spoke of. All right, excellent. So here's one. According to the stats, what is the most common type of mortgage rate UN staff go for? So, we talked a little bit about the rates. Share some insight on that.
You mean what might be the most popular mortgage loan program, I'm assuming? So, yes?
It could be. They had said rates, but I guess like when you talked about your fixed rates versus your adjustable rate mortgages, so the most common type.
Yeah, well, fixed rate mortgages have been very popular over the past 2 years just because they've been so incredibly low that a lot of members have said, I'm just going to go for the fixed rate anyway, even though it might be a little bit higher just because they've never been so low, historical low rates. Traditionally, over the 20 years that I've been here, other than these past 2 years, our most common or most popular loans for UN staff people tend to be probably the 7-year adjustable rate mortgage. So that's a 30-year loan. The interest rate is fixed for the first 7 years, and then it adjusts annually thereafter. I mentioned that statistically, our mortgage loans last for about 6.5 years. UN staff members tend to move every, number of years, maybe 6 years. So the 7-year adjustable has traditionally had a very, very competitive and low interest rate that's attractive. The length of the fixed term fits the needs of a lot of our members. The other thing to remember is that outside of the United States, fixed rate mortgages really don't exist in many places. In the vast majority of countries where people are taking mortgages, the rate is variable or adjustable in some form or fashion. So I think members who have any experience with home buying or home financing outside of the US are already somewhat comfortable with a variable rate mortgage, and the low rates and fixed period of our 7-year adjustable tends to be the most popular loan that we offer over a long period of time. Yep. The 7-1 is the winner.
I like it. We brought in casinos. Now we have the winning numbers. We're
right.
Good. All right. What about this? In the case of UN consultants where they have varying contracts, how would that impact this process?
So the credit union is able to make mortgage loans or loans in general to consultants. Ultimately, we consider a consultant or we review a consultant's application file as we would a self-employed person. So that means that we need to show a 2-year history of consultancy. And we average the income out over the past 2 years. So we gather or obtain this consultants, this members' contracts for the past 2 years, average it out because there could be gaps in between, and that is the income that we use for a consultant. It's the same way that we would review someone who works as a consultant in the United States, completely separate from the United Nations. Someone who is a business consultant and they work for a variety of different employers over time. We would gather their employment contracts, or in the United States case, we would gather their tax returns over 2 years, average it out, and that's the determination. So it is a restriction for consultants. They need to have a 2-year history in order to be able to qualify for a mortgage loan.
Okay, excellent. Thank you. So going back to G4 visas, Chris, I think this one may be yours, or hopefully you have the winning response. But what is the capital gains tax rate for G4 visa holders? It sounds like they've heard some word that it is a straight 30% for selling homes, but you can share some insight on that.
So I always have to start this out with saying I'm not an accountant. You actually do need an accountant to determine these numbers for you. But so whereas we say that you're withholding the 10% or that 15%, the actual tax rate, and the reason why I don't want to say it straight, it usually is around 30%, but it's 30% of the profit. It might actually be a little higher these days. It might be closer to 33, but I would definitely pull in my accountant to confirm this. But it's also profit based on improvements made to the property, purchase price that you had for the property, anything that you have receipts for that you can show, as well as you can also, if you're using it as your primary resident, there are exemptions available to you as well. So it's very hard to just say 33% or 30% or whatever that number it is. You really want an accountant to maximize the amount of money you save on your capital gains.
Got it. Makes sense. Makes sense. So again, with the additional team members. So looks like we are coming up on time for our segment here with the Q&A. So Chris, I just wanted to throw it back to you and give you an opportunity to share, any additional insight as far as the role of the real estate attorney.
I am a fan of meetings ending early, so I'm going to keep this one brief. And I appreciate everybody being a part of this, and I see that the numbers haven't even dropped in participants, so I'm really glad. And I do want to give you good information on what we do. But essentially, my job is to coordinate between the parties and to read all the paper that you wouldn't have time to read yourself. Early on in the transaction, when you first get your accepted offer, there are things I can't do. I can't tell you the value of the property. There's an appraiser for that. I can't tell you the safety of the property. There's an inspector for that. But I can read through the agreements for you and make sure that you're protected in the event that your mortgage is denied or the building that you're applying for doesn't allow you to buy. The other, and I think the most important part, if you're buying within New York City or New York City or the 5 boroughs, when you're buying from a co-op or condo, somebody has to review the building's documents to see what your rights are in relation to the building as a whole. Also to read the financial documents in the building to make sure that there's no major losses in the money, that they have reserve funds in order to cover future events or capital improvements that they need to take. And I think the best thing you have, if you're buying a house on Long Island or up north, you don't know anything about your neighbors. You don't know anything about the neighborhood other than what you can Google. But when you buy into a building like a co-op or condo in New York, there are monthly meetings held by the managers of that building where they will talk about everything from the budget to whether there's fights among neighbors, smelling smoke in hallways, loud noises, construction down the road. And this is a useful tool. So probably one of the most important things I do for a review is go down to the building and review those monthly meeting minutes. And now, even during COVID, we were able to get down there if we had to, because I find that it is invaluable to a buyer in the city. And then as the transaction goes along, while you're applying for your mortgage, you're applying to be approved by the board. I'm there because I know the loan officer at the bank, and I know the people at the board and the broker as well who's helping with the application. And I'm just helping people get information faster throughout that. There's another side job that we do behind the scenes called reviewing title for you. Reviewing title is basically making sure the property you're buying is yours. And then finally, the closing itself, my job is to direct who brings what money to the table. But I think I talked to that pretty clearly early on when I talked about like modern closings. And that's pretty much everything. And I feel good about doing it these days.
Good, and we feel good that you partnered with us. Chip, any last words that you want to add as far as the UNFCU side?
Thank you for attending and for listening and hopefully learning some. We would love to work with you on the purchase of a property wherever it may be in the U.S. And, you know, as your credit union, we really welcome the opportunity to work with you. So please contact us.
All right. Thank you. Thank you both, Chip and Chris. This was excellent. We will definitely stay connected. We do have questions that continue to come in, so we do want to get answers out. So we'll probably reach out and use your resources to be able to respond to all of these. But thank you again.